Options trading changed my life at 16 years old. And in this video, I'm going to be going over options trading for beginners. This is going to be part one. So stay tuned and let's get straight into it. Step one, what account should you use and how much you put into each trade, your account size, etc. First things first, you need a good broker. I like TD Ameritrade or E-Trade if you're under the age of 18. If you're over the age of 18, you could use Webull as well. Next, what kind of account should you use? I would definitely recommend using a cash account. The difference between a cash account and a margin account is that as a beginner trader, you're probably not going to have over $25,000. And I wouldn't want to trade with that much money either as a beginner. So what you should do is open up a cash account, which is going to allow you to trade with unlimited day trades under $25,000. Rather than a margin account, you're only going to have 3 day trades every single week. Next, how much should I put into my account? So say you have $5,000 sitting in your bank account and you want to start trading with $5,000, right? I would only recommend probably putting about $1,500 of that money into your account. Why? Because I'd say 99% of day traders blow at least 1 to 2 accounts before getting the hang of it and becoming successful. And that's part of trading. You're going to blow accounts. You're going to lose money first, unless you paper trade, which we're going to talk about that in a bit. But I would recommend probably putting about 20 to 30% of the money that you want to start trading in your first account so that you can lose all that money, still be fine with your life, and you're willing to lose that amount of money and you'll still be able to trade since you only use $1,500 out of that $5,000. And next, you're gonna do the same thing. You can trade with another $1,500. Maybe you're gonna get it this time. Maybe trading is gonna hit, or maybe it's not. And then if it doesn't, they're gonna have another $2,000 to trade with. So that's definitely very, very, very important when figuring out how much I put into every single account that I have. Next, starting off. First things first, we're going to talk about paper trading. Paper trading is good, but don't rely directly on paper trade. Because the truth is that in trading, you learn from losing money. So if you don't lose money at first, then basically you're not going to learn because it's all about learning from your mistakes, and it's just like paying a tuition to learn a valuable skill. So I would recommend paper trading, but only paper trading to figure out your strategy, back test your strategy. And once you start finding success within your strategy from paper trading, then you can go into real trading. And that's going to allow you to already have an edge. So hopefully you don't even have to lose that much money when you're starting. So paper trading's good, but it's all about how you use it. So by back testing, I mean going over strategies for the last week. Okay, I'm going to be going over if the VWAP crossed the 9 EMA, would this have worked how many times within the last month? And back test that, Journal your trades from paper trading. You could connect your account to it or figure out, okay, I paper traded this setup this many times. This is how much times it's worked. I paper traded this setup this many times and it's worked this many times. I paper traded at 9 a.m. and it sucks compared to when I paper trade after 2 hours after open at 11 a.m., etc. And then finding your strategy with paper trading is all about testing out different setups, strategies until you find the one that fits you through paper trading. Next, I'm going to be talking about finding your own options plays. So for everyone, it's different. Some people have scanners. Some people have, a certain amount of stocks to look at every single day. My number one tip for this topic for you would be to stick to a number of stocks, maybe 3 to 4 stocks that have liquid contracts. You know how to trade them, and you can just memorize those stocks. Some stocks you can use are SPY, AMD, NVIDIA, Microsoft, Apple, Tesla. Those are a few that I like. Personally, for me, I just stuck to a few stocks when I started trading. But then now I'm at the point where every single night and every morning I scan through around 20 to 30 stocks that I have on a watch list. And I just look to see, okay, is this relatively strong compared to the market, and is this relatively weak compared to the market? And I kind of find those stocks, and if the market goes up, I'll play dips on the relatively strong stocks. If the market goes down, I'll play the retest on the relatively weak stocks. Number 3, this is a very confusing part of trading in options. How do options work? So first things first, I'm going to be talking about expiration, contracts, dates, premiums, all that good stuff that sounds confusing, but I'm going to make it very simple. So when you load up to your broker and you go to options trading, it's going to say strike and expiration. So basically, the strike of your contract is going to be out the money or in the money. So say the stock's at 380. If you're buying a call, then out the money would be 381 and in the money would be 379. Since 381 is out of the price, 379 is inside of the price. For my personal trading strategy, I always like to buy a little bit out the money. So say the stock's at 380, I'll either buy 381 or 382 calls, depending on the price of the contracts. So that's slightly out the money. And then as far as contracts, I usually like to play either weeklies on tickers that don't have 0 DTE and tickers that have every DTE, meaning every day till expiration. I like to trade 1 day out. I don't trade same days. I trade 1 day out. So again, strike, I usually like to do a little bit out the money, so $1 to $2 away from the current price of the stock. And for the date of my contracts, I usually just do the same week if I'm day trading, or if it's a stock that has an expiration every single day, like an index, like SPY, QQQ, SPX, something like that, then I'll trade 1 DTE. Next, options Greeks. So options Greeks, they really depend on whether you're swinging or not. If you're swinging, then yeah, you need to know your options Greeks. And I'd say the 2 most important options Greeks, I'm going to go over them right here, are delta, gamma, and theta. Here we go, guys. Delta, the underlying estimated move of how much an options contract will move based on every $1 move up or down. So for example, say our options at $2 and the delta is 50 cents, right? If the stock goes up $1, then the option is going to go to $2.50. Here's another example. Say our contract's at $1 and the delta is 30 cents. The stock goes up $1. That means our contract goes to $1.30. So the delta is just what's added onto your contract for every $1 move up in the stock. The gamma is a delta's expected rate of change. So every $1 move up or down, the delta is going to move up 10 cents if the gamma is 10 cents. So say your contract's at $1 and the stock goes up $2 and the gamma is 10 cents. The first dollar up, your contract is going to go to $1.30. Your second dollar up, the gamma gets added to the delta. So 10 cents plus 40 cents, it's going to be $1.70. Next, theta, this just calculates time decay. So if the theta is minus 0.05 and you're swinging the contract, then every single day, your option's automatically going to open down 5 cents. So you have to subtract that. Next, I just want to really go over support and resistance real quick. And if you ever see a stock in this type of range, it's usually best to not trade it because range trading and options can really mess you up if you don't know how to correctly trade it. I would rather look for breakouts and retest of breakouts and retest of breakdowns so that you can maximize on the price of your contracts. Next, want to sell dash hold and how to buy options. So when you're buying an option, the first thing you want to do is make sure there's not a spread on the contracts, meaning the bid and ask aren't far away from each other. So you want to always make sure that the bid and ask is at least like If it's more than 5 to 10 cents away and you're a beginner, I would be careful because you can think you're up 10% and then accidentally sell the bid and you're down. So I would look for liquid names like SPY, Qs, Nvidia, Tesla, AMD, stocks like that when trading options. And the way that you want to buy them is you can either do limit or market. So go on your broker right now. Say, for example, go to SPY 450 calls that expire tomorrow. When you want to buy it, I personally, on indexes, I'll do market because there's only a 1 cent spread. But on anything else, I'll do limit, and I'll usually try and just buy a little under the ask, depending on how bad I want to get in. So if I think there's a little bit more room down, then maybe I put my order at the bid. But if I want to get in right there and right then, I'll either buy market or buy ask. Want to sell dash hold your options. So many people think you can't make your money trading unless the stock goes to your strike price. This is not true at all. Say you have Nvidia and you have $500 calls, and Nvidia goes from 450 to 480. You're still making money even though it's not at 500. For like another thing, say Qs are at 370 and you have 372 calls, and they go to 371. You're still making money in your contracts even though it's not to the strike. Like, you don't need it to go in the money to make money. Remember that. Think about it like this. As the stock goes up and the option gets closer to your strike price, the value of the option goes up as they become a safer investment as we get closer to the current strike price. So always remember that you don't need a hold until that happens. So how do you know when to sell and how to hold? First of all, you should always have a stop loss in place so that you don't lose a ton of money trading options because they can move fast. They really can move fast. So I would recommend having a stop loss in place and a plan in place, meaning, okay, is this my take profit? This is the level that I'm going to hold at, or this is my first take profit. This is my second take profit, etc. And then what you can end up doing is once you only have runners, you can put a trailing stop loss on your contracts. Meaning, so say you're up 50% and you only have a quarter left of your position. So you sold 75 of your position and you're running runners free. What you can do is put a 15% trailing stop loss. Means every single time the stock goes up 15%, the trailing stop loss rides with it, but it doesn't go down with it. So think about it like this. Stock's going up, the trailing stops. How to do it? The trailing stop is going up with it, but then if the stock starts to go down, the trailing stop stays here. And then if it hits, then you get stopped out. Next, entering the sizing into trades. Scaling in and out, confirmation, how much you should put in each every trade, etc. First things first. Should you scale in and out of trades? If your plan is to scale into the trade, then do that. But if your plan wasn't to scale into the trade, then do not average down into the trade. Waiting for confirmation is so important, guys, while trading. You need to wait for confirmation. And you might ask, what is your confirmation? Your confirmation is different. Like my confirmation is a 5-minute close over under with a retest, meaning say we're at a breakout point, right? We're at a breakout point. We break out. My confirmation is that we come back down to the breakout point, hold it, and then come back up. That's my confirmation because it tells me that the resistance became a support, which means that it's a solid level. Or your confirmation, say there's a big level at 100 and we're at 99 and we go to 150. If we close that 5-minute candle over the key pivot, that's confirmation. But if we got a wick, so that means sellers take control, then that means it's bad for the stock. So how much should you put in each trade? If you have a small account, I would recommend putting 10 to 15% in every single one of your trades, risking about 20% on every trade. So you're risking 2% of your account, and I would try and make 4 to 5% every trade. Meaning if you're risking 20%, I would try and make 40% every trade. If you're so If you're risking 1 to 2% of your account, you can make 3 to 4% of your account, meaning you have a 1 to 2 risk to reward ratio, which is awesome. Next, market psychology. This is so important while trading options because options are volatile. They're a risky investment, and if you don't know how to control your emotions, you'll lose. First things first, not quitting while trading. Remember, the market, they want your money. They want to take your money. So not, quitting is big, but at the same time, like I knew for myself when I wasn't a successful trader, I told myself, I am going to do this. There is a fire inside of me that it won't stop unless I become a successful trader. You need to have a drive inside of you. You need to have a fire inside of you that will not stop unless you become a successful trader. And if you don't have that in there, then you're not fit for trading because 99% of people fail at trading. And to be a part of that 1%, you really have to have something inside of you. And I really, truly believe that. Overtrading absolutely kills in options. It kills. So what I'd recommend is if you take more than 2 losses in a row, stop for the day. Or if your max loss hits for the day, stop for the day. For example, say your max loss is $500. Right when you get down $500, even if you're still in a position, close out your trade and stop trading for the day. This is going to result in you not having big drawdowns and to keep your losses small. Next, overcrowded trade. So I want to bring something to your guys' attention. Most people see a lot of people on a stock or on an option and they want to get in. They have FOMO, like, oh man, everyone's on it. It must go up. It's the dumbest way to think because think about it like this. What did I tell you guys? 99% of people fail at trading, right? And the market makers, they always win. The market always wins. That's the truth. So would you want to be on the side that 99% of people are on a trade? No. Why would you want to be on a trade with every single other person in the world when the truth is almost everyone loses? If anything, you're going to want to run as far away as you can from that trade. So if you see an overcrowded trade, I wouldn't necessarily go against it, but I will just stay away from it. Last but not least, averaging down. This it really hurts because the truth is that 90% of options, I'd say, end up at zero. Probably 99% of options end up closing at zero. So if you're not quick with options, especially if you're day trading them, then you're going to lose a lot of money. Averaging down is the number one way to lose money. And this is different than scaling in. If your plan is to scale in, that's fine. But if your plan wasn't to average down, then don't average down. Because what's going to end up happening is they're going to give you hope. You're going down. They're going to give you hope a little bit and you want to buy more. So you want to get even and boom, they want to go down. And then you're like, oh man, I'm already stuck for this month. Let me make my average a little lower. And then what's going to happen is you're going to keep on losing money. And that's the truth. But guys, that's it. That's part 1 of options trading explained for beginners. If you enjoyed, make sure to drop this video a like, subscribe to my channel. Much more educational content coming. This is just a start. Also, if you want to learn from me, trade with me, and so much more, links in bio and description. Tap in. Let's make some money. I'll see you guys next week for part 2. Peace.